Hi, and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's see the analysis.
Friday, February 20th, 2026. The markets have closed, and the ticker tape for Ondas Inc., that's ONDS, is telling a pretty violent story. The stock settled today at exactly $10.03. That is a massive decline of 11.94% in a single trading session.
Yeah, and we aren't talking about a sleepy, low-volume Friday drift here either. This was a stampede. Over 112 million shares changed hands today. Just incredible volume. The stock hit an intraday high of $11.58 before the floor just absolutely fell out, dropping to a low of $9.95. And this comes right on the heels of a highly volatile week, where the stock was trading at $11.07 just 24 hours prior.
It is a brutal chart, honestly. If you're just staring at the last 48 hours, I won't sugarcoat the tape. It looks like capitulation. But if you zoom out, if you look past the red candles of this week, you see a company sitting on a true war chest of $1.5 billion in cash and a backlog that has jumped 180% year over year. The market is panicking, clearly, but the fundamentals suggest we are looking at a fortress.
Oris, the market is finally doing the math on the actual cost of building that fortress. You have a stock trading significantly below its recent $16.45 capital raise price. You have a bearish report from J Capital Research calling the company an incinerator of cash. And you have what I can really only describe as a dilution tsunami of warrants hanging over every rally like the sword of Damocles. The question isn't just about the technology anymore, it's about whether the equity structure makes this uninvestable.
And that really is the central conflict we need to parse today. Is Ondas a system of systems giant in the making? One that can realistically 5x its valuation to $25 billion by 2036? Or is it a collection of disparate acquisitions weighed down by integration risks and a capital structure that just actively punishes the retail shareholder? I fall on the side of the technology in the capital mode. The capitalization and their detect-to-defeat tech stack create a defensive moat that entirely justifies the growth thesis.
Right. And I look at that same capitalization table and I see zero margin for error. The dilution and the insider selling we've seen signal deep structural risks. But walk me through your case first. Why should anyone step in front of this falling knife right now?
Because the market reaction this week is noise. It's noise masking a very clear signal. Ondas has fundamentally transitioned. For years, this was a story stock. It was a promise of future autonomy, a slide deck with cool drones. As of early 2026, it is a delivery stock. The volatility we're seeing completely ignores the operational validation happening on the ground.
Operational validation is a very strong term for a company that is still bleeding cash operationally.
But look at the liquidity. $1.5 billion in cash on hand. In the defense and industrial sector, cash isn't just a safety net. It is a strategic weapon. We know how this industry works. The government pays slowly. The cycles for a program of record take years. That specific constraint routinely bankrupts smaller competitors who have better tech but shorter runways. With $1.5 billion, Ondas has effectively front-loaded their capital needs for the next decade. They can outweight the bureaucracy. They don't have to worry about the lights going out.
I see why you emphasize the cash. It's a big, shiny number, but you are completely glossing over where that cash came from. That $1.5 billion war chest was bought by crushing the retail shareholder. The January 12th offering raised $1 billion. Yes, but it was priced at $16.45. The stock is now hovering around $10. That indicates a complete rejection of that valuation by the secondary market. The people who bought that deal, the institutions, the retail investors, they are underwater by nearly 40% right out of the gate.
The market digests large raises inefficiently. It takes time for the shareholder base to rotate from short-term traders to long-term holders.
It's not just digestion, though. It's structural damage. We have to talk about the warrants. There are warrants for over 121 million shares, exercisable at $28.
Which is significantly higher than today's price. That shows confidence in the upside, doesn't it?
It shows a cap on the upside. Think about the mechanics of it. That creates a massive ceiling. Every time the stock tries to run, every time it even approaches that $28 level, The market knows there was a supply of 121 million new shares waiting to flood the float. It mutes the rally. And frankly, the J Capital report from January makes a very compelling argument that this capital isn't being used for organic growth. It's being used to plug holes in money-losing acquisitions. They characterize the company as incinerating cash.
Look, incinerating is a motive language designed to provoke a sell-off. It's highly biased.
Is it though? When you combine that burn rate with insiders selling over $12 million in stock in the last 90 days, including CEO Eric Brock selling $4.6 million, the signal I'm getting isn't growth, it's exit. If the future is so bright, why are the architects cashing out before the building is finished?
I want to address the insider selling later because there is nuance there regarding tax obligations, but we cannot have an honest debate about the valuation without understanding what they're actually building. If the tech is real, the financial engineering is justified. You mentioned acquisitions. You call them money-losing. I call them the necessary components of a moat. The core debate here has to start with the technology stack, specifically the detect-to-defeat ecosystem.
Fair enough. Let's look at the tech. They've spent hundreds of millions assembling this puzzle.
It's not a puzzle. It's a unified solution. The crown jewel here is the acquisition of Centrix, which completed in November 2025. This changed the game. Most counter-UAS, that's unmanned aircraft systems defense, relies on jamming.
Right. Blasting radio frequencies to disrupt the drone. It's the standard industry approach.
Exactly. And jamming is messy. It's a sledgehammer. It interferes with friendly signals. It disrupts local Wi-Fi. It's actually dangerous in commercial environments like airports or stadiums. Centrix provides cyber over RF, or co-RF.
Cyber over RF sounds great in a press release, but what does it actually mean in the field? How is it fundamentally different from jamming?
It means precision. Co-RF doesn't just scream noise at a signal. It identifies the specific communication protocol of the rogue drone. It hacks the handshake between the drone and its operator, takes it over, and lands it safely in a designated zone. It disconnects the pilot without the pilot even realizing what happened initially. It's not a hammer, it's a scalpel.
Okay, theoretically, that is superior.
It's not theoretical, though. On February 17th, the German state police deployed Centrix scout units. On February 13th, NATO infrastructure placed an order for the Iron Drone Raider. This is the only domestic player combining kinetic interception, meaning physically stopping the drone, with this cyber takeover capability. In the year of the drone, as analysts are calling 2026, owning the takeover technology is the differentiator. You can't just jam everything anymore. The airspace is way too crowded.
I'm not disputing that the individual technologies have merit. The concept of taking over a drone is clearly where the industry wants to go. My concern is the Frankenstein nature of the company structure. You have American Robotics, you have Aerobotics, you have Centrix, you have the mine-clearing units. These are companies from different continents with completely different code bases.
It's a portfolio approach.
It's a logistical nightmare. They are stitching together different software stacks, different hardware manufacturing cultures, and different supply chains. Scaling FAA-certified platforms like the Optimus drone is incredibly difficult manufacturing work. Hardware is hard. If they fail to operationalize these into one smooth platform, they are going to get eaten alive by the prime contractors.
The primes, companies like Lockheed, Raytheon, they move too slow. They just can't innovate on software this fast.
Maybe, but AeroVironment or Lockheed Martin can spin up production lines that dwarf what Ondas can do. They have the supply chains, the factories, the cleared personnel. If Ondas is just a holding company for 5 different startups, that $1.5 billion is going to burn up fast just trying to make the software talk to the hardware. You're betting heavily on integration, and integration is where most M&A fails.
I think you underestimate the cohesive power of the software layer they've built. But let's pivot to the other side of the business. The call option that everyone seems to forget about because they are so focused on the shiny drones. The railroads.
I wouldn't say I forget about it. I just really struggle to value it. It feels like a legacy anchor dragging on the growth story.
You shouldn't struggle. This is the dark territory argument, and it's massive.
Define that for the listeners who aren't rail buffs.
Dark territory refers to the vast stretches of rail track, mostly in the western U.S., where there is no cellular coverage, no fiber, no reliable comms at all. It's a black hole for data. The Association of American Railroads, the AAR, has designated Ondas's proprietary standard as the absolute mandate for the 160 megahertz upgrade in these areas.
Right, the upgrade for the legacy voice networks.
It's so much more than voice. It's safety-critical signaling for Class 1 railroads. It ensures trains don't collide in the middle of nowhere. It allows for longer trains and tighter scheduling. Ondas has a monopoly on the standard. If a Class 1 railroad wants to run automated signaling in dark territory, they essentially have to use Ondas technology. This is a 10-year recurring revenue stream just waiting to unlock.
Waiting being the operative word there. Look at the Q3 2025 revenue. The network segment, the railroad business, was 0.8% of total revenue. Less than 1%.
Well, because the rollout is just starting.
But railroads move at a glacial pace. They are capital-intensive and incredibly risk-averse. Relying on this for near-term valuation support is dangerous. It's a call option, sure, but it's one that might not pay out until 2029 or 2030. In the meantime, the valuation is being propped up entirely by the drone narrative. If the drone side stumbles, the railroad side isn't big enough to catch the falling stock price.
It's a call option with a regulatory mandate behind it. That's rare. But let's talk about that valuation because that is where the rubber meets the road. My thesis, is that Ondas can 5x its valuation to roughly $25 billion by 2036.
I've seen the projections. I find the math, let's call it highly optimistic.
It's grounded in TAM expansion, total addressable market. The counter-UAS market is projected to hit $19 billion by 2035. The global drone market is heading toward $147 billion. Ondas doesn't need to win the whole market. They don't even need to be the biggest player. They only need 10 to 15% market share.
Which equates to what in hard numbers?
About $3 billion in revenue by 2036.
Only $3 billion? They're targeting $170 million for 2026. That is a massive gap to bridge. You're talking about roughly 17x revenue growth over a decade.
That is exactly how S-curves work in technology adoption. If they hit the 170 million to 180 million target this year, the compound growth begins. If you apply a price-to-sales multiple of 8.6x, which is fairly standard for high-growth defense tech, on $3 billion in revenue, you get your $25 billion market cap. The math works perfectly.
The math works only if you assume the share count stays static, which we know it won't. And it assumes they can maintain that multiple. Right now, trading at around $10 with a $5.13 billion market cap, they are trading at roughly 75 times sales.
It's a premium for growth and liquidity.
It's an astronomical premium that leaves zero margin for error, 75x sales. If they miss that $170 million target even slightly, say they come in at $150 million, because a government contract gets delayed, which happens literally all the time, the re-rating will be brutal. We could see this stock cut in half again. The market is pricing in absolute perfection.
You're focusing too heavily on the downside variance.
I'm focusing on the dilution math. To 5x the stock price, the market cap might need to 10x or 15x to account for the warrant exercises. The earnings per share hurdle is massive. When those warrants execute at $28, the pie gets sliced into significantly smaller pieces. The company might be worth $25 billion, but your personal share of it will be diluted.
The warrant overhang is a valid concern, I will grant you that. But remember, if those warrants are exercised, that brings in another massive influx of cash. It further fortifies the balance sheet. It becomes a virtuous cycle, if execution holds.
If execution holds. And that brings us right back to management. You waved off the insider selling earlier.
I did, because we need to look at alignment. CEO Eric Brock was granted 13.5 million restricted stock units, RSUs, in February 2026. That vests through 2029. He only profits if the stock performs over the next 3 years. He is heavily incentivized to make this work.
RSU grants are free money. It's upside without risk. If the stock goes to zero, he lost nothing out of pocket. But when an insider sells stock they bought or sells a significant portion of their existing holdings, that is the real signal. Brock selling $4.6 million in December 2025, right before the stock started this volatile chop, contradicts the supercycle narrative. If he truly believed the company was about to 5x, why sell $4.6 million worth of exposure?
Because tax obligations on vesting equity are significant.
Executives often have to sell to cover the tax bill when shares vest. It's automatic. It's not a grand conspiracy.
$12 million across the C-suite in 90 days. That feels like more than just taxes. That feels like taking chips off the table while the war chest narrative is hot. It feels like they are selling into the liquidity provided by the retail investors.
Or it's simply diversification after years of building the company. We can speculate on motives all day, but we can't know for sure. The bottom line is, they have the capital. They have the contracts to German police, NATO, the Israeli demining operations, and they have the technology that no one else has.
The technology is fascinating. I will absolutely give you that. The cyber over RF capability is a genuine differentiator in a crowded field. But the financial engineering here is frightening.
Let's bring this home. Summarize the bear case for me.
It really comes down to this. You have a stock trading well below its offering price. You have a massive warrant overhang that acts as a gravity well on the price, preventing sustained rallies. You have a valuation at 75x sales, which is nosebleed territory, and you have a bear report screaming about cash incineration. The dilution tsunami makes this a dangerous hold. The burden of proof is entirely on the execution of that $170 million revenue goal. Until I see them hit that number without burning another $200 million, I remain highly skeptical.
And I see it differently. I think the market is severely mispricing liquidity. In 2026, cash is king. $1.5 billion solves the number one risk for small-cap defense stocks, which is survival. They can outlast the skeptics. The 180% backlog growth proves the system of systems is working commercially. This isn't a science project anymore. It is a defense prime in the making. Buying now after this violent pullback to $10 is buying a potential giant during a temporary sentiment crisis.
It's a bold bet.
The debate really rests on the next 3 years, 2026 through 2028. Will Ondas be an incinerator of that $1.5 billion as you fear?
Or will that capital fuel the capture of a $147 billion autonomous market?
Precisely. The listener has to decide if the backlog visibility outweighs the dilution risk.
And whether they trust the management to spend that war chest wisely.
That is exactly where we leave it.
If you like this video and want to watch more content like this, don't forget to subscribe. Thanks for watching. See you.